The factors that contribute to stock prices include market forces like market news, either positive or negative, price momentum in the international markets, price change in similar stocks of same industry. Lastly, even the earnings of the company play a major role in determining the price of its shares. If a company's results are better than expected, the price jumps up. If a company's results are worse than expected, then the price will fall. Speculative activities undertaken by the traders could also impact prices adversely. Coming to corporate actions. Corporate action is any event that brings material change to a company and affects its stakeholders. This includes shareholders, both common and preferred, as well as bondholders. These events are generally approved by the company's board of directors. Shareholders are permitted to vote some events as well. When a publicly traded company issues a corporate action, it is initiating a process that will bring actual change to its stock. By understanding these different types of processes and their effects, an investor can have a clearer picture of what a corporate action indicates about a company's financial affairs and how that action will influence the company's share price and performance. Splits, dividends, bonuses, mergers, acquisitions and spin-offs are all examples of corporate actions. Bondholders are also subject to the effects of corporate actions, which might include calls or the issuance of new debt. Moving on, stock split is a technique through which the number of shares of a listed company is increased without changing the total outstanding shares in the market. A stock split or a stock divide increases the number of shares in the public company. The price is adjusted such that before and after market capitalization of the company remains the same and dilution does not occur. It simply increases the number of shares in the hands of existing shareholders. So how does a stock split work? Take for example a company with 100 shares of stock priced at $50 per share. The market capitalization is 100 into $50 or 5,000. The company splits its stock 2 for 1. There are now 200 shares of stock and each shareholder holds twice as many shares. The price of each share is adjusted to $25. The market capitalization is 200 into $25 or $5,000, the same as before the split. Ratios for 2 for 1, 3 for 1 and 3 for 2 splits are the most common, but any ratio is possible. Splits for 4 for 3, 5 for 2 or 5 for 4 are used through less frequently. Investors will sometimes receive cash payments in lieu of fractional shares. The primary motive is to make these shares seem more affordable to small investors even though the underlying value of the company has not changed. Let's look at some stock splits in India. Starting with Ruy Back, a listed company, the average share price of the stock was around Rs 1039 before the split. On 22nd July 2005, post split on 25th July 2005, it was traded at Rs 504. However, market capitalization didn't change much post split. Let's take another example. Bharti Airtel split its stock face value from Rs 10 to Rs 5 with the ratio of 2:1. So the market price changed from Rs 800 to around Rs 400 post split. On the other hand, a reverse stock split is the opposite of a conventional stock split. In a reverse stock split, the number of shares are reduced and the face value of the stock is increased. However, the market capitalization still remains the same. A reverse stock split is also known as a stock consolidation or share rollback. For example, if before the split a company has around 10,000 shares of 50 cents each, after the split the company will have around 5,000 shares at $1 each. The reverse split does not add or reduce any real value to the company. Reverse split may well come under renewed selling pressure since now the share has become clearer. Also, there can be pressure from exchanges as they generally specify a minimum bid price for a stock to be listed. If the stock falls below this bid price, it risks being delisted. The limited liquidity may also widen the bid-ask spread, which in turn deters trading and short selling. The ratios associated with reverse splits are typically higher than those for forward splits, like 1 for 10, 1 for 50 or even 1 for 100. Let's illustrate the concept with a real life example. In 2011, Citigroup had launched a reverse stock split at a ratio of 1 for 10 shares. Citi's stock price had slipped to around $4.5 in April 2011. Many large investors don't prefer stocks trading below $4. In order to avoid such sentiments, Citi had taken a decision of a reverse split. Therefore, the number of outstanding shares were reduced from 29 billion to approximately 2.9 billion. Let's look at a few of the important dates in stock split. We have split record date, the date on which the shareholders who own the stock will be eligible for the split. We have split pay date, that is the date that the stock, dividend or split will be paid. We have split execution date. It is always to be the first trading date following the split pay date. On this date, the stock price will be adjusted and you should see the additional shares in your brokerage account. Moving forward, in a buyback, the issuing company repurchases the outstanding shares from the market, thereby reducing the liquidity of the stock. It is a management strategy to either increase the value of shares or to eliminate any threats by shareholders who may be looking for a controlling stake. Coming to feature of buybacks, buybacks increase the proportion of shares a company owns. Generally, shares are bought with a certain time frame and at a premium to the current market price. A company may buy back its shares without shareholders' resolution to the extent of 10% of its paid up equity capital and reserves at any point of time. Let's illustrate it with an example of a tech giant, Apple. It was observed in the last quarter of 2013 that the Apple stock had slipped below market sentiments. CEO Tim Cook noted the drop and spurred the buyback. The company took a bold step and went ahead with the buyback. Apple purchased shares worth $14 billion in a period of 2 weeks in January 2014. Now that we have covered buyback, let's take a look at bonus shares. Bonus shares are distributed to existing shareholders based on the number of shares they hold, but without changing the total market capitalization. These shares are distributed at no additional cost. These are the company's accumulated earnings which are not given out in the form of dividends but are converted into free shares. Companies issue bonus shares to encourage retail participation by increasing their equity base. When the price per share of a company is high, it becomes difficult for new investors to buy shares of that particular company. An increase in the number of shares reduces the price per share, but the overall capital remains the same even if bonus shares are declared.